Welcome back. It's great to have you with us as we continue our journey. We are now going to shift our focus to a very specific and influential force in the world of anti-money laundering, one born directly from the financial industry itself. When we think about international standards, we often think of governmental or quasi-governmental bodies like the Financial Action Task Force. The Wolfsberg Group is a different kind of entity, and understanding its role is crucial, particularly if you work in or with major international financial institutions. It isn't a regulator or a government body with legal enforcement powers. Rather, it is an association of some of the largest global banks in the world, including names like Barclays, Goldman Sachs, and JP Morgan Chase. This group came together voluntarily around the turn of the millennium, recognizing that the private banking sector presented unique and substantial money laundering risks that required a specialized, harmonized approach. Their primary goal was, and remains, to develop frameworks and guidance for the management of financial crime risks, with a particular emphasis on establishing best practices for private banking and correspondent banking. Think of their work not as law, but as the collective wisdom of industry leaders trying to define what doing the right thing looks like in their specific, high-stakes corner of the financial world, setting a benchmark that is now globally recognized. Its influence is immense, as regulators and auditors frequently use the Wolfsberg principles as a yardstick against which a bank's own policies and procedures are measured. So, why the intense focus on private banking? This area of finance is inherently high risk for money laundering due to the very nature of the services it provides and the clientele it attracts. Private banking caters to high net worth individuals who by definition command significant assets and often have complex financial arrangements spanning multiple jurisdictions. The services offered are highly personalized, relationship-driven, and prize discretion and confidentiality, which, while legitimate business features, can be easily exploited by those seeking to obscure the origins of their wealth. A money launderer might seek to use the prestige and complex products of a private bank to lend an air of legitimacy to illicitly obtained funds. Furthermore, these clients often utilize sophisticated legal structures like trusts, shell corporations, and foundations, adding layers of anonymity that make it challenging to identify the ultimate beneficial owner and the true source of funds. The relationship managers in private banking are under pressure to attract and retain significant assets, which can sometimes create a conflict with their compliance obligations. It is precisely this combination of wealth, complexity, confidentiality, and potential for conflicts of interest that makes private banking a prime target for abuse, necessitating a more robust and specialized set of controls than what might be standard for retail banking. The cornerstone of the group's contribution is the Wolfsberg anti-money laundering principles for private banking. The first, and perhaps most critical, of these principles is that a bank will only accept clients whose source of wealth and funds can be reasonably established to be legitimate. This goes far beyond simply collecting identification documents. It demands a deep, substantive understanding of the prospective client's story. The bank must perform thorough due diligence to understand who the client is, what their business and personal background consists of, where their fortune came from, and what the purpose of the account will be. This involves obtaining corroborating evidence and not simply taking the client's word for it. For example, if a client claims their wealth comes from a successful manufacturing business, the bank should seek evidence such as financial statements, media reports, or other independent verification. Any reluctance from the client to provide this information, inconsistencies in their story, or connections to illicit activities are significant red flags that should lead the bank to refuse the relationship. Establishing this comprehensive client profile at the outset is the foundation upon which all other AML controls are built, as it provides the baseline against which all future activity will be judged. A central pillar of the Wolfsberg principles is the intense scrutiny applied to politically exposed persons, or PEPs, a topic we will delve into more deeply later, but must introduce here. The group defines PEPs as individuals who are or have been entrusted with a prominent public function, and this extends to their immediate family members and close associates. The principles mandate that relationships with PEPs can only be established with the specific approval of senior management, not just the relationship manager. This ensures that the heightened risks associated with these clients are acknowledged and accepted at a high level of authority within the organization. This isn't about denying service to public figures, but about recognizing the elevated risk that their position and influence could be abused for the purposes of corruption, bribery, and laundering the proceeds of those crimes. The level of due diligence must be enhanced, meaning the bank must take even greater steps to understand the client's source of wealth and the specific source of the funds being deposited. The ongoing monitoring for PEPs must also be more rigorous, as their circumstances and risk profiles can change rapidly. A bank must have a clear and documented process for identifying PEPs, obtaining senior approval, and conducting this enhanced and continuous oversight throughout the entire client lifecycle. The principles strongly emphasize that customer due diligence is not a one-time affair conducted only at the start of a relationship. It is a continuous, dynamic process of updating and maintaining client information and risk profiles. The Wolfsberg Group advocates for a risk-based approach to this, meaning that the frequency and intensity of reviews should be proportional to the client's risk level. A high-risk client, such as a PEP or someone operating in a high-risk industry, should have their file reviewed more frequently than a lower-risk client. These periodic reviews ensure that the information the bank holds remains current, including details about the client's business, the nature of their wealth, and the expected transaction patterns. Furthermore, monitoring is not just periodic, it must also be event-driven. A significant and unexpected transaction, negative media coverage about the client, or information suggesting a change in their circumstances should trigger an immediate review of the relationship. This ongoing monitoring is what allows a bank to detect deviations from the expected activity established in the initial client profile, forming the basis for identifying potentially suspicious behavior that requires further investigation. The goal is to ensure the bank's understanding of the client evolves along with the client's own activities and risk profile. Following logically from ongoing monitoring is the principle of identifying and reporting suspicious activity. The Wolfsberg principles require that a bank staff be trained to recognize the red flags of money laundering and that the bank must have clear procedures for escalating concerns. When a relationship manager or other employee observes activity that is inconsistent with a client's known legitimate business or personal activities, or for which there is no reasonable explanation, they have a duty to escalate it internally. The principles stress the importance of an independent compliance function that can review these internal escalations with objectivity. This compliance team is responsible for conducting a further investigation to determine if the suspicion is credible. If, after its review, the bank concludes that it holds a reasonable suspicion of money laundering, it is obligated to report this to the appropriate financial intelligence unit or law enforcement agency in accordance with the relevant national laws. This process must be handled with the utmost confidentiality to avoid tipping off the client, which could compromise an investigation and is illegal in many jurisdictions. The effectiveness of this entire system relies on the vigilance of all employees and a robust internal process for evaluation and reporting. Crucially, the Wolfsberg principles place ultimate responsibility for the anti-money laundering program squarely on the shoulders of the bank's senior management and board of directors. A successful AML program cannot be delegated solely to a compliance department. It must be embedded in the institution's culture, a concept known as the tone from the top. Management is responsible for ensuring that the AML program is given the necessary resources, including a sufficient number of skilled staff and adequate technological tools for monitoring and analysis. They must also champion a culture where compliance is valued and where employees are encouraged to raise concerns without fear of reprisal. This includes overseeing the development and implementation of clear policies and procedures, ensuring that all relevant staff receive appropriate and ongoing training, and appointing a qualified and independent chief AML officer. By holding senior leadership accountable, The Wolfsberg Group ensures that fighting financial crime is treated as a core business priority, not merely a regulatory checkbox exercise. This top-down commitment is seen as essential for fostering an environment where AML controls can be genuinely effective across the entire organization. While private banking was the initial focus, the Wolfsberg Group extended its expertise to another notoriously high-risk area: correspondent banking. This is the practice where a large international bank, the correspondent, provides banking services to a smaller or foreign bank, the respondent. The inherent risk here is that the correspondent bank is processing transactions for the respondent bank's customers, whom the correspondent has never met or performed due diligence on. In essence, the correspondent bank is relying on the AML controls of the respondent. The Wolfsberg correspondent banking principles state that a bank must conduct thorough due diligence on its respondent banking clients, not just the institution itself, but also the types of customers it serves and the regulatory environment in which it operates. This involves assessing the quality of the respondent's own AML program to determine if it is robust enough to be relied upon. The principles specifically warn against providing services to shell banks, which are banks with no physical presence or affiliation with a regulated group. By applying a rigorous, risk-based approach to accepting and monitoring respondent banks, the Wolfsberg principles aim to prevent criminals from exploiting the correspondent banking system to move money across borders with anonymity. I hope this detailed exploration has provided a clear picture of the Wolfsberg Group's significant role. See you in our next session.